Right now, as you're watching this, something is happening inside the global financial system that most Americans have absolutely no idea about, and the people who do know about it are either too afraid to say it clearly or they're just hoping it quietly goes away. It won't, because what we're talking about is Japan, a country most Americans think of as a quiet, reliable ally, sitting on a financial position so enormous, so deeply woven into the fabric of American life, that if it moves, even slightly, it moves everything you own, everything you owe, and everything this country borrows to keep running, and it has been moving. Japanese investors' total foreign assets rose to nearly $495 trillion in the third quarter of 2025, near an all-time high, holding roughly $2.54 trillion in equity and investment fund shares and $2.41 trillion in debt. That is not a number from a textbook, that is a live number. That is Japan's grip right now on the arteries of the global financial system. And the question that nobody in mainstream television is asking out loud is this: what happens when Japan starts pulling that money home? Let me walk you through exactly why this matters, why it's already started, and why what's unfolding right now in Tokyo has direct consequences for your mortgage rate, your retirement account, your grocery bill, and the basic ability of the United States government to pay its own bills. Let's begin where all serious analysis has to begin, with the facts on the ground. Japan holds approximately $118 trillion in U.S. Treasury assets, which ranks it at the top spot among the largest U.S. Treasury holders globally, with its central bank and institutional investors purchasing these securities to help manage the exchange rate and maintain stable foreign reserves. But here's what most people miss: the Treasuries are only part of the picture. When you add Japanese holdings of American stocks, corporate bonds, mortgage-backed securities, and other assets, you start to understand just how deeply Japan is embedded inside the American financial system. This isn't a foreign country parking some cash. This is the single largest external creditor relationship in the world, and it has been built over decades on a very specific set of conditions that are now, one by one, dissolving. To understand what's changing, you have to understand how this relationship was built in the first place. For 30 years, Japan operated under near-zero interest rates. Deflation ruled. Domestic returns were essentially non-existent. So what did Japanese institutions do? They went searching for yield abroad. This strategy, known as the carry trade, grew to an estimated $1.2 trillion. Hedge funds, pension funds, insurance companies, and banks around the world borrowed in yen to fund investments in US tech stocks, emerging market bonds, real estate, and countless other assets. It was one of the greatest arbitrage operations in financial history. Borrow cheap yen, deploy it into higher-yielding dollar assets, pocket the difference. For decades, it worked beautifully. The problem, as always, is that it worked so well for so long that the entire global financial architecture quietly became dependent on it continuing forever. It is not going to continue forever. In fact, it is unwinding right now, and the reason it's unwinding is structural, meaning it's not about one news event, one tariff, or one election. It's about Japan's underlying economic reality changing in ways that cannot be reversed by a press conference or a diplomatic handshake. As of March 2025, Japan's general government gross debt was about $1,324 trillion, roughly 235% of GDP, by far the highest among major advanced economies. For decades, this was manageable because Japan could borrow at essentially nothing. The government was paying almost nothing to service its debt, despite owing more than $10 trillion. But with the recent shift away from zero interest rates, servicing this debt increased by 10.8% to Y31.3 trillion, the first time this figure has surpassed Y30 trillion. Think about what that means in plain terms. Japan has been living in a kind of financial suspended animation. Massive debt, but manageable, because rates were essentially flat. Now rates are rising. And when you are carrying debt equal to more than twice your entire economy, even a small rise in rates is not a small problem. It is a compounding catastrophe in slow motion. Japan's bond market crashed on January 20th, 2026 after Prime Minister Takaichi announced snap elections and a Y21.3 trillion stimulus package, including a food tax suspension. The 40-year JGB yield hit a record 4.24%. The 30-year jumped 25 to 30 basis points in a single session, the largest daily move since 1999. Veteran bond traders in Tokyo stood and watched in real time as something that had defined their entire careers simply broke. A market known for its silence, its predictability, its almost glacial stability, cracked open in a single afternoon. And within hours, the tremors were felt in New York, London, and Frankfurt. Now here is where this connects directly to American households. As the largest foreign holder of U.S. Treasury bonds, Japan's financial stability is crucial to the U.S. Rising Japanese yields are making investment within Japan more attractive, and the costs of hedging against yen and dollar currency fluctuations are also making U.S. investments less profitable for Japanese institutions. As a result, Japanese investors are likely to begin selling their U.S. Treasury bonds and repatriating their money back to Japan. This withdrawal of billions of dollars from the U.S. market will directly impact America's ability to finance its own debt, especially as the U.S. already pays over $1 trillion annually in interest on its debt, exceeding its defense budget. Let that sink in. America is already paying more in interest on its debt than it spends on its entire military. And one of the key forces that has kept that interest burden from being even worse, Japanese demand for U.S. Treasuries, is now reversing direction. This is not speculation. Over 3 years from January 2022 to January 2025, Japan's total U.S. Treasury holdings decreased from 1.29 trillion to 1.07 trillion, a reduction of approximately 220 billion. And in just the first 2 weeks of April 2025, Japan sold over $20 billion in U.S. government bonds, $17.5 billion in the week ending April 4th, followed by an additional $3.6 billion the following week. That is real capital leaving real fast, and the consequences were immediate and measurable. The sell-off contributed to a spike in yields on 10-year U.S. Treasury bonds to 4.592%, marking the most significant weekly increase since 2001. The combined effect erased approximately $1.7 trillion in U.S. market value almost overnight. Higher yields increase U.S. debt servicing costs, potentially raising them by $270 billion annually by 2027, according to Congressional Budget Office warnings. The dollar index dropped 2.1% in just 2 weeks as central banks trimmed their dollar reserves. $270 billion more in annual interest payments. That's not an abstraction. That is money that either has to be borrowed again, taxed out of your pocket, or printed into existence, each of which carries its own chain of consequences that reach into everyday American life. Higher mortgage rates, more expensive car loans, a weaker dollar that quietly taxes every purchase you make. Now let's talk about the carry trade, because this is where the global dimension of this story becomes genuinely alarming. If either the cost of borrowing yen increases or the value of the yen changes, the carry trade unravels. As the cost of borrowing yen increases, traders involved in this massive multi-trillion-dollar global trade will panic. They will be forced to quickly sell off their global assets, U.S. bonds, stocks, real estate, to cover their yen-denominated loans. This sudden, simultaneous sell-off by banks, insurance companies, and massive funds could trigger a global financial shock and cause markets to crash abruptly, seemingly without warning. We already had a preview of this in August of 2024. The Bank of Japan raised rates by a fraction, and within 48 hours, the U.S. stock market fell sharply. The Japanese stock market experienced its largest single-day drop since 1987, and financial commentators scrambled to explain what was happening. Most of them couldn't, because they weren't watching the yen, they weren't watching Japan, they were watching earnings reports and Fed minutes, focused on the visible layer of the story, while the structural layer was shifting beneath it. Japan's life insurance sector alone held an estimated $5 trillion in foreign assets. In early 2026, unrealized losses on domestic bond portfolios at major insurers were estimated at wide $9 trillion, or $60 billion, forcing a strategic retreat from foreign markets. These are not hedge funds making aggressive bets. These are massive, conservative institutions, life insurance companies, pension funds that have for years been anchoring global bond markets with their patient, reliable demand. When they retreat, the demand disappears. And when demand disappears in bond markets, yields rise. And when yields rise in America, everything from your monthly mortgage payment to the interest rate on the national debt moves with it. Japan's finance minister recently suggested that Japan's U.S. debt holdings could serve as a card on the table in trade negotiations with Washington, marking a shift from previous positions where Japan refrained from linking its bond holdings to trade discussions. That statement matters more than most people realize. For decades, there was an unspoken understanding: Japan holds American debt not as leverage, but as partnership. It was the financial expression of a security alliance, a post-World War II arrangement that made sense in a world where U.S. military protection was Japan's primary strategic need. But that world is changing. Japan is under growing pressure to align with Washington's efforts to economically contain Beijing, especially through tech decoupling and trade realignment. However, China remains Japan's largest trading partner, leaving Tokyo caught between strategic allegiance and economic pragmatism. This is the deeper geopolitical reality that the financial numbers are expressing. Japan is not simply making investment decisions based on yield calculations. Japan is navigating an increasingly dangerous position between its security dependency on the United States and its economic dependency on China, and the $4.6 trillion in US assets it holds is no longer just an investment portfolio, it is a geopolitical instrument. It is a source of national leverage in a world where the rules of power are being rewritten in real time. Japan has sold over $220 billion in US Treasuries over the past 3 years, including $20 billion in April 2025 alone. China, the second biggest owner, has also sold massive amounts amid tariffs and deteriorating relations. Beijing has taken steps to reduce its reliance on the dollar while strengthening the yuan's global position. And now consider that these two moves, Japan repatriating capital for domestic reasons, China selling for strategic ones, are happening simultaneously in the same direction at the same time that America's debt is at record levels and its political capacity for fiscal discipline is, to put it charitably, unclear. The People's Bank of China has pointed to the risks associated with the US dollar's dominance as the global reserve currency, saying that US fiscal and financial regulatory problems could spill over, while the dollar could be weaponized in geopolitical conflicts. What's interesting about that statement is that it's not wrong. The dollar has been weaponized through sanctions, through swift exclusions, through asset freezes. And every time it has been weaponized against one country, every other country in the world quietly updated its risk models to ask, could this happen to us? The answer, increasingly, is yes. And so the slow, steady diversification away from dollar-denominated assets continues, not in a dramatic crisis move, but in the gradual, patient way that structural shifts always happen until suddenly they don't look gradual anymore. Japan is reportedly exploring regional settlement systems denominated in yen, particularly with ASEAN nations. There may be increased interest in gold, other foreign currencies, or potentially digital assets as part of diversification efforts. Japanese investors also purchased the most European bonds they had bought since 2020, redirecting hundreds of billions of yen into German and French debt. This is what a quiet financial realignment looks like. It doesn't announce itself, it doesn't come with a declaration, it comes in the form of capital flows, gradual, persistent, structural, that over time reshape the global financial order without anyone on the evening news having to say the words reserve currency collapse. $7 trillion represents roughly half of annual US Treasury issuance or multiple years of European government borrowing. Flows of this magnitude would materially impact global bond markets, potentially suppressing yields in recipient countries while elevating them in Japan. The scale of what is potentially moving is difficult to fully comprehend. This is not a rounding error. This is a tectonic shift in where the world's savings are being stored and deployed. Annual interest payments on Japan's debt are projected to rise from Y-mark 10.5 trillion in fiscal year 2026 to Y-mark 16.1 trillion by fiscal year 2028, a more than 50% jump. Total debt service costs are expected to jump from Y 28.2 trillion to Y 35.3 trillion over the same period. This is the domestic pressure that is driving the repatriation. Japanese institutions are not selling American assets because they hate America. They are selling because Japan's own financial house is under strain, and the logic of holding low-returning foreign assets while domestic yields rise and domestic fiscal needs expand is becoming harder and harder to justify to shareholders, policymakers, and pensioners. And here is perhaps the most important point, the one that ties all of these threads together. The stability of the US financial system for the past 30 years has been, in ways most Americans never understood, subsidized by Japan's financial dysfunction. Japan's zero rates made US rates look attractive. Japan's institutional need for yield drove demand for US debt. Japan's quiet, reliable purchasing of Treasury bonds allowed the US government to spend beyond its means at manageable cost. That subsidy is ending, not because of a geopolitical confrontation, not because of a trade war, though that's accelerating it, but because Japan's own structural conditions have changed, and those changes are irreversible in the near term. Japanese investors in the past have been particularly aggressive in buying debt in other markets, particularly in the US, where interest rates have been higher than in Japan. But now that Japanese yields are going up, Japanese bond investors may be more likely to stay home and invest in their own bonds rather than in the US, and that could put significant upward pressure on US bond yields. What you're watching unfold right now is the global financial system adapting, painfully, imperfectly, with enormous risk, to a world where one of its foundational assumptions is no longer true. The assumption was this: Japan will always need to send its money abroad because there's nothing worth buying at home. That assumption is gone, and the reversal of capital flows that follows is not a crisis in the traditional sense. It's not a crash, not a panic, not a Lehman moment, at least not yet. It's something more subtle and in many ways more dangerous. It's a structural repricing of American financial conditions happening right now in real time that will make everything from government borrowing to personal finance more expensive for years to come. The Americans who understand this are positioning themselves accordingly. The Americans who don't are going to wake up one day and wonder why interest rates won't come down, why the dollar feels weaker, why their savings aren't stretching the way they used to. The answer will be the same answer it always is when you look past the headlines and into the actual mechanics of global power. Someone else's decision, made in a different time zone, for their own perfectly rational reasons, changed the conditions of your life without ever asking your permission. That's what Japan's $4.6 trillion grip on U.S. assets means right now, and that grip is loosening.